LeBron James is what you would call a high wage earner, and he probably pays an income tax rate of up to 35%. But Governor Mitt Romney is a different kind of rich. He makes most of his money from investments, not a paycheck, so he pays a much lower tax rate. Last year, it was 14%. It's because the U.S. tax code treats investment-related earnings like capital gains much differently from wages and salaries.
95% of the benefits of the lower tax rate on capital gains and dividends goes to people in the top 20%, and almost half of it goes to people in the top 0.1%. Those are people with incomes above $2.2 million a year.
Why does it matter to the taxman how you earn your money? J.D. Foster is with the Conservative Heritage Foundation.
The capital gain is a tax on the change in wealth. It's really a wealth tax, not an income tax. We integrate the two systems because it's convenient to do so, but a capital gain is a change in wealth, it's not income.
He says in many cases, capital gains are already taxed at the corporate level before they ever end up on an individual's tax return. The lower rates also encourage investment, helping grow the economy. But critics don't buy it.
But we have a long history of different capital gains rates over almost 100 years, and there's no evidence that it helps the economy or even helps investment.
Bob McIntyre of Citizens for Tax Justice says the tax code's treatment of capital gains creates confusion, complexity, and plenty of ways for people to score lower tax rates.
It's also the reason why the tax code, the biggest reason why the tax code is so complicated, because people who can do it take their wages or other forms of income and they manage to get them treated as capital gains.
Long-term capital gains are taxed at 15% right now, but if there's no solution to the fiscal cliff by January, that rate will increase to 20%. Sylvia Hall, NBR, Washington.